Today's episode is Schedule C deductions. And so if you're listening to this, it's probably because you're either self-employed or maybe you've received a 1099 in the mail, and you're trying to figure out how to save on taxes. And so what a lot of people may not realize is, if you have a side gig, for example, and you're working for someone, and instead of putting you on the payroll, they send you a 1099. Well, all of a sudden, you're a sole proprietor and you're self-employed, just like someone who's running their own small business, for example. And with that comes potentially higher taxes that you weren't expecting in the FICA, Social Security, and Medicare. And so we want to help you save as much as possible. And so what a lot of people don't do is deduct everything they're entitled to.
Yeah, so like you just finished up on the 1065s, and you're starting to get a lot of those business returns done. So what are the most common things that people tend to miss they're deducting?
Yeah, that's a good question. There are a lot of deductions that people don't think of. And so one of the more frequently missed that I see would be a home office deduction.
And home office is, the business portion of your home, basically, right?
Yes. So if you are self-employed and you have some office space that you work out of in your home that's specific for your business, you can deduct a percentage of all of your annual home expenses, such as utilities, mortgage interest, property taxes, homeowners insurance. Those would be the main items. Even some repairs on like the home office area, things like that. And so you take the square footage of the office versus the square footage of your entire home, and you come up with that percentage. And so a lot of people don't even think to do that. You can also add depreciation of your home. So whatever your cost of your home was, you have to separate the land value out of that. But you can take a small percentage of your house as a depreciation on the home office deduction. That's a really big one.
So another thing on the home office deduction is some people will put their internet or cell phone as part of their home option or home office, and then they're only taking a percentage of that. So there are some what we call direct expenses that would be 100% business write-offs, and then what Nick was talking about is the indirect expenses that are only based on the percentage of business use of that home office. So an example of a direct expense may be your cell phone, your internet, your computer equipment, your printers, things like that are 100% write-off. Those either need to be listed as direct expenses of the home office, or those can go directly on the Schedule C. Just make sure you're getting 100% on those items. For a cell phone, it may not be 100%. It may be 95% or 90%, but don't take only the home office percentage of those.
Right. So yeah, be sure to go with your accountant and figure out which ones you can take a little more on. Another one is vehicles, right? Like you have a personal vehicle that you're using for your business, and you're not sure if you're even allowed to take anything for it, but you can take it
Right.
two different ways. And so the first way is like the actual vehicle expenses, right? So if you're only 50% vehicle business use, then you can take 50% of all of your actual expenses on it, which would be, filling it up with gas and doing any kind of repairs on it, taking depreciation on it. Anything else I'm missing out of that?
Yeah, even like your vehicle insurance, for example.
Right, yeah.
You can take whatever the business percentage of that vehicle is. Yeah, you can take that percentage of all of those things. Interest expense if you have a loan on the vehicle. And so, typically people think mileage, and sometimes mileage is great, but sometimes taking the actual expenses could potentially be better. And so that's something that you should look at, and it depends on different factors. If you have a more expensive vehicle, and maybe you don't drive as much, then it's probably going to be more beneficial to take the actual expenses at that business use percentage. But if you have, an older, cheaper vehicle and you drive a lot of miles, then it's probably going to be more beneficial to take the standard mileage deduction.
Yeah. Which is
is
like 58 in
actually,
absence.
it actually changed midway through 2022. So part of the year it's like 56 cents, and then the other part of the year it's like 58 cents or something. It's somewhere in there. Sorry, I don't have those exact numbers, but yeah, just think about 57 cents a mile, for example. So if you drive 1,000 miles for business use, you would just get $570 as a deduction. Whereas if you drove 1,000 miles for business use and 10,000 miles for the year, then you're taking 10% of all your fuel, interest, repair and maintenance, oil changes, depreciation, 10%. I left something out, fuel, if I didn't say that. But yeah, so you just kind of have to weigh both options.
And it's an important calculation because a lot of people want to buy a new business auto. They want to slap it on that tax return, take 100% deduction. Great. But keep in mind, if you turn around and sell it the next year, you're going to recapture that depreciation in whichever year you sell that vehicle, you will have to recapture that.
Yep. And that recapture is ordinary income. So you're going to be taxed on that. And so you need to be ready for that. If you don't have a new vehicle, you're potentially, turning around to use for business.
Yeah, exactly. So yeah, two different options on that, mileage or actual cost. And we tend to, when our clients come in and they tell us they have a personal vehicle, we're like, all right, we'll run it both ways and we'll see what benefits you the most.
Right.
So we do that for new clients especially, and then going forward.
And also just to emphasize the importance of tax planning. So don't just look at the current year. Look at what you're going to be doing next year. You're going to sell it. You're going to keep it. Don't just look at 1 year.
Yeah, exactly.
You won't be happy with the result.
Right.
Exactly. And you don't want to deduct the actual expenses and then the following year try to deduct mileage, right? You want to pretty much stick with whichever method you go with on per vehicle.
Right, because you can't switch. You're not allowed to switch back and forth. So once you do the standard mileage deduction, you're stuck with that.
Right.
That's why planning ahead is so important.
Exactly. Into the future. So another thing is that people tend to, we talked a little bit about it, is insurance premiums. What insurances can you deduct? You can deduct vehicle insurance if you are taking the actual expenses. And then another one is like business liability insurance.
Workers' comp.
Workers' comp is deductible. Other ones?
Business personal property, business real property.
Anything, business real property. And then property taxes on your personal home would go into the home office deduction. Right. So if you're, have 10 square feet of office space and a 100 square foot home, you get 10% of your property taxes written off through the home office deduction as well.
And Nick, you can also just mention what happens when you're collecting sales tax and paying that in. Do you want to report gross sales or net sales and how that works?
Yeah, the sales tax is supposed to be essentially just like a pass-through. So you're not including sales tax in gross revenue, and you're also not deducting it. However, sometimes people don't do it that way, and they actually include their sales tax in their gross revenue. And if you do that, you want to make sure you are including that as a deduction line item. But typically the way that you'd see that done is to not include it in revenue and not include it in expenses.
And that would be for sales tax or hotel tax. Anything that's a pass-through tax that you're going to collect and remit just like you do withholding tax.
Right. We're going to go over some more deductions, but real quickly, I just want to emphasize, if you are an employee somewhere, you're kind of out of luck in terms of deducting things like mileage. Any kind of unreimbursed employee expenses are no longer deductible. You would have to go to your employer and maybe see if they have a reimbursement plan for things like that. So if you're getting a 1099 and you're self-employed, yes, it could be negative because you have to pay more in that FICA instead of paying only the half and the employer matching half. You're your own employer, so you have to pay the 15.3%. So you're potentially looking at a higher tax liability than an employee. However, the employee doesn't get to write things off. And so as a self-employed 1099, contractor situation, there's actually a benefit to that, because if you really keep up with all your deductions throughout the year, you can potentially, end up really lowering your tax that you have to pay on that income. So
You may pay a higher rate because you're going to pick up the 15.3 for the FICA tax or SEC tax, but your overall liability could potentially be lower because you get to deduct so many different things.
right. And so if you're self-employed, if you're getting a 1099, you want to think about what are you using for the business, right? So for example, we talked about the home office deduction, we talked about mileage and the vehicle expenses, but there are also things such as cell phone, computers, different types of equipment that potentially you bought years ago that now you're using for the business. And so maybe it's not 100%, but you still want to think about allocating a certain amount of, maybe your cell phone bill or your computer cost to a business expense deduction. And that's something that I feel like a lot of contractors don't think about and miss out on.
Right.
Make sure you're going line by line through all these things every year to make sure you're picking up all of that.
So I always think what's helpful is when you are making a purchase, you're self-employed, you're making a purchase, think about, is this a big business deduction or how can this be a business deduction?
Yeah.
So if you need to make a trip to Walmart and you're purchasing your groceries, but you're also purchasing printer paper, that counts, So if you're taking a vacation and you can work that into business travel, it is okay to structure your lifestyle to accommodate business deductions. So if you're always thinking about how can I make this deductible, you're going to get a lot more deductions at the end of the year.
Right. And would you recommend for a sole proprietor, for example, not an LLC, just a sole proprietor, still setting up a different bank account for the business expenses just to
Definitely.
more organized?
Definitely. So we always want those business accounts separate from the personal accounts. Even if you're not incorporated or you're not operating an LLC, you still need to have a DBA and have a bank account with that DBA that only receives business income and only deducts or pays out business expenses. Don't mix the two. That makes an audit very difficult.
Right.
Yeah. Yeah. And if you ever need your accountant to go back through your bank statements, it costs more to go back through the bank
Exactly.
statements. So keep it as simple throughout the year. And you end up reaping the rewards.
And keep it separate.
It's separate. Yeah.
Right. So in that example, if you go to the store to buy groceries, but you're also buying printer paper or a couple items for business, just have two transactions
Exactly.
with two different cards. Even though that's a little bit of a pain, it is absolutely worth doing it that way to stay organized.
And then the miles to go purchase that are 100% deductible.
So travel, you mentioned that. That's a really potentially great deduction to take for the sole proprietor, for someone who's self-employed. So there are some limitations on that. However, you can potentially go on a business trip that is also vacation and write off that entire trip, right? But there are some certain ways you need to structure that.
Sure. And that's why you see a lot of the conferences, business conferences and things like that in places that you would want to vacation anyway.
Right.
Yeah.
They're just writing those off.
Right.
Yeah. So for example, if you fly to a destination, you're going to be there for a business conference of some kind, but then you're going to spend one day there totally for pleasure, you can still deduct those plane tickets at 100%. But if you're going to go to a conference one day and then spend a week for pleasure, then that doesn't fly. So there are some rules on that, but you still, like Mitzi said, you really want to be focused on how can I incorporate my personal life into my business so that I can really take advantage of deductions.
And if the trip ends up not being primarily business, it's primarily vacation. I'm going 4 weeks to Europe, but I'm going to spend a week of it using it to learn a different language or something that does incorporate into your business, you can deduct that portion. But since your primary purpose is vacation, that's when you can't deduct, any kind of travel stuff like that that's just related to your vacation. So you can still structure it a little bit that way, even if you can't make it primarily business at specific time.
Just to go through a few more items, if you're watching this and you have no idea what you can deduct, I just want to kind of go through a list of some of the common things that you should be thinking about. So I'm just going to go through it. I mean, first of all, advertising, if you're paying to promote your business on Facebook or some kind of social media platform, you want to be deducting advertising. Accounting, if you're paying someone or an accountant, or if you're paying for an accountant's software like QuickBooks or any, paying to do a business tax return, for example.
Those tax prep fees are often missed.
That's right. Legal and professional kind of falls into a similar category there. If you're paying for an LLC formation or something like that, that's a deduction for the business. Office expenses, paper, pens, things like that. Supplies, if you're making T-shirts, selling them on eBay or something, you obviously are going to want to deduct your supplies, the T-shirts, those costs of goods sold, paint or however you're doing your T-shirts. Repair and maintenance is a big one for people in like the construction world or really a lot of industries. Meals is one that can often be missed at restaurants, so if you're going to have a meal with a client, or if you're taking out one of your employees or something to a meal at a restaurant, you can deduct up to 50% of that meal in 2022. So that's one that a lot of people don't think about.
Is it 50% in 2022 or 2023?
I'm sorry, I forgot we're in the year 23. Yeah, so it was 100% because of COVID the past 2 years, but now in 2023 it is back to 50%.
Right. Yeah.
Forgot what year we were in here. But yeah, the telephone, computer, any type of equipment, vehicle expenses like we talked about. If you're paying someone for labor, if you're paying someone for contract labor, now make sure you're filing 1099s if you're paying that person $600 or more.
And so we have a checklist that includes all of these, and we'll attach that in the description.
Right.
So one thing I always like my clients to do is when they're getting their tax information together, go through the checklist, because it might trigger, oh, I forgot about that. So we have a checklist for self-employed individuals. We have a checklist for writing off automobile expenses, home office expenses. So those 3 checklists are super helpful. And then we also have year-end checklists for things that you need to do by the end of the year, as far as retirement planning and things like that. So we'll attach those in the description, and that way you can download them and it might trigger some additional deductions.
Yeah, so there's a lot more that we haven't mentioned, but we'll include our checklist in the description of the video. But yeah, ultimately the goal of this episode is just to remind you that if you're self-employed, if you're getting that 1099, there's no reason to pay tax on 100% of what your 1099 says, because you are absolutely, able and you should deduct everything that was related to your business income if you're receiving a 1099.
And don't forget this self-employed health insurance. That's another one people miss a lot. That one is Medicare. So the portion that you paid for Part A or Part B in your Medicare, that can count as self-employed health insurance. So make sure you analyze, if you're self-employed and you had income, analyze what did it cost you for health insurance. If you haven't deducted it through another employer, that counts as self-employed health insurance and it's deductible.
Right. So if your spouse is employed and has, you covered in their insurance, you're not going to be entitled to that. Right. But if you're paying out of pocket, that's a good one.
So essentially, sorry, did you have something else to add?
Well, I was also just going to mention, if you have any kind of employee benefit program, like retirement program set up, that's another potential good deduction for someone who's self-employed.
Yeah, so any of the self-employed plans like the simple IRA, the SEP,
Health savings account, health reimbursement account.
self-employed accounts. Yeah.
Mm-hmm.
So the biggest way to make all of this happen is keep track throughout the year as much as you can. Go back and make sure you got everything. But the easiest thing for you and your accountant at the end of the year when tax time does come is if you have that separate business account, or if you're keeping all your receipts in one spot, so you're not digging. The best way just to make sure we don't miss anything is if you keep track all year long of the things like meals, and if you go to Walmart, keep those purchases separate, because otherwise you're going to be going back through 12 months of receipts and trying to figure out what you can deduct. And yeah, it would just make it easier if for tax time, if an audit ever does happen, just staying prepared. So
Definitely. One last thing I'll say too is what I'll see a lot of times is the client didn't keep up with any receipts. So, as the accountant preparing the tax return, we don't need to see every single receipt from your business expenses. However, you need to be saving those in your files in case the IRS ever audited you. They're going to want to see receipts. They're not going to want to see bank statements. That's not going to fly in an audit typically. And they're going to want to see actual receipts. So you don't necessarily need to give your accountant all of your receipts, but you do want to save those. And so that's just something to mention.
And how long do we recommend they save them for?
I would recommend at least 3 years. That's generally going to be the statute of limitations for an audit. However, it can be as much as 7. If something was way underreported, for example, the IRS can go back up to 7 years to audit.
And for fixed assets, those you keep indefinitely until you dispose of that asset.
Mm-hmm.
Point.
So really, yeah, at least 3 years. But really, if you can keep them for 7, that's better. And I would say just if you have some type of file folder year by year, just to keep all of those business receipts. And that's another reason why it's good to have that separate bank account, even if you're a sole prop or just kind of having a side gig where you have a 1099. You still want to keep any of those business expenses separate.
And some people want to keep the physical receipts. Some people just want to take pictures. Either is acceptable. And so the thing about physical receipts is some of that ink will fade, and you won't be able to read those receipts, and neither will the IRS, and they won't count. So it's a good idea, really, just to scan in your receipts. And if you're a real small business, you could save those receipts by month. You could do it by month. And then if you get audited, you've got a list of your expenses. You're only looking through 1 month worth of expenses. So you don't have to organize by date and by vendor and go through all of that for a really small business.
We hope this video was helpful. Let us know in the comments below if there are any questions you have on items maybe that you want to try and deduct. Feel free to reach out if you need any help with managed accounting services, tax planning, or tax preparation. We'd be happy to help. Thanks so much for watching.